afternoon, everybody. Thanks for joining us. This is Tom Smith from Trade Monster. Before we get started, and before I introduce Chuck Hughes, I want to let everyone know that you can go to mytrademonster.com. Tomorrow, I should have this webinar archived. Click on Free Education. You'll see our upcoming webinars as you did today, but you'll see our archives. Some of the archives, if you want to go through, you can play them, you can download them, whatever you'd like to do. But I will have this archived and listed up sometime tomorrow. I'm hoping around noontime. In the meantime, if you have any questions, you can go to My Trade Monster, hit our email address, and we can go ahead and converse that way if you'd like. Otherwise, why don't we go ahead and see if Chuck's with us. Chuck, are you with us?
Yes. Can you hear me, Tom?
I can, Chuck. Happy New Year to you, my friend, and thank you very much for putting together another educational webinar for us.
Oh, yeah. Happy New Year to everyone. And it's great to be here. I really enjoy doing these educational webinars, and we all appreciate the time you spend, Tom, to set this up. So Happy New Year to everyone, and I've got a really interesting presentation today.
Luckily for me, Chuck, I was able to see it, preview it before everyone, and I'm excited to go through it and share it. So for those of you, I know we're going to have a lot of questions, but Chuck has a lot of material to cover, and we have a short time to do it. So by all means, don't hesitate to ask a question. Just put it in the chat area, and I'll try and address all the questions I possibly can, as well as Chuck. But if not, Chuck's going to give us information for contact support, things and general questions that he can address for you as well. On a brokerage end, again, don't be scared to go to mytrademonster.com and communicate with us that way. Otherwise, Chuck, I'm going to go ahead and give you the presenter's role, and let's go ahead and get started.
Okay, sounds good, Tom.
It's coming over now.
Okay.
Okay, we're live.
Okay, great. All right, good afternoon, everybody. This is Chuck Hughes. I wanted to talk today about trade management. That's something we don't discuss that much, but it's a very important part of having a successful trading program. And I would even say it's as important as your trade selection process itself. So today we're going to look at stock and option trade management. I use different parameters for option trades than I do for stock trades because options are more leveraged. We're going to look at directional and spread trades, and then I've got some trades that you can take tomorrow that meet the trade selection process, and I'm going to show you a couple trades that look really good if you want to take them tomorrow. And then at the end, we'll have a question and answer session, and I'd be glad to answer any questions you have today. So let's talk about the overall trade management goals for my trading. I like to maintain a 3-to-1 or higher profit-to-loss ratio. And the profit-loss ratio is a measure of risk. And the higher that number is, the less risk you have and the more profitable your portfolio is. So my overall goal throughout my whole trading career has been to maintain a high profit-to-loss ratio. And the other goal, of course, would be to produce consistent monthly returns in your account. And we're going to take a look in detail at the trade management guidelines I use on a daily basis in my portfolios. And let's just take a look at this, an example of this profit-to-loss ratio. I'm showing you a snapshot now of closed trade results for my advisory service. This was several years ago, December of 2011. So what I have listed in this table are the closed trade results for that particular month. And what I did is I went and I added the profitable trades. I added all the profits for the profitable trades, and that totaled just over $40,000. Then I added up all the losing trades, and the total for the losing trades came to $2,600. So if we divide the gross profits of $40,000 by the gross losses of 2,600, we come up with a profit to loss ratio of 15-1. So that's higher than my goal, which is 3-1. And we'll have some months that we exceed that goal and some months that we were under that goal. But the overall goal is to achieve that 3-1 profit to loss ratio in your trading. And this would apply to any types of trades you do, whether it's stocks or options. You always want to try to maintain a 3-1 profit loss ratio or higher. So I'm listing here the money management guidelines I use every day. You never want to risk more than your initial investment. That's always the number one money management guideline, is to take what I call limited risk trades and never put yourself in a position to lose more money than you invest. Because if you take an unlimited risk trade, it can go south and has gone south before. So you always want to limit your trades to limited risk trades that you can't lose more than your initial investment. So all of the strategies I'm going to talk about today are what I call limited risk trades, and you can't lose more than you invest. So that's always the number one trade management guideline, is to never risk more money than you have in your account. So another guideline I use is I try to limit the size of my trading positions to 10% or less of your portfolio. You want to close out your losing trades before they develop into large losses. And you don't want to limit your profits by selling your winning trades with a small profit. I know that goes against human nature. When you get a profit, you like to take it. It feels good, but that's an important rule, is you want to hold on to those winning trades, because it's those big winning trades that really provide the bulk of the profits in your portfolio. We also want to take both long and short trades. Now, I don't have any short trades on now because the market trend is up, but there have been periods in the last two bear markets we've had almost exclusively short trades. So you just want to keep that in mind, that you want to have that flexibility, and you want to use a system that will get you short during bear markets, because there's a lot of money to be made in bear markets, as we did in the last two bear markets. So also you want to take both directional trades and spread trades, and I'm going to show you some examples of that here in a minute. But that's also an important part of a balanced portfolio, in my view, is to have spread trades as well as directional trades. The spread trades, of course, can profit in up, down, or sideways markets. And in 2010, 2011, 2012, when we had very choppy, volatile, non-trending type markets, we favored the spread trades more than the directional trades. 2013, the market started trending better, so we had more directional trades. But I always trade both directional and spread trades at all times, just to diversify my portfolio. And I always like to invest using several different types of strategies for diversification. And I'll show you those strategies here in this presentation. So let's look at first stock and ETF stop loss guidelines. When I enter a stock or an ETF trade, I'm talking about a directional trade now. If that stock drops 7 to 10% below my entry price, then I'm out. I simply sell. I take my loss before it develops into a big loss. Because if you let a small loss develop into a big loss, it can really, really hurt your performance in your portfolio. For example, if you lose 50% on a trade, it's going to take a 100% gain just to break even from that 50% loss. And if you lose 75% on a trade, it's going to take a 300% return just to break even. So using these stop losses helps me maintain that 3-to-1 or better profit to loss ratio, which I have been able to maintain over decades. I also like to buy in 1/3 or 1/4 increments, and I like to build a position over time and purchase in increments only if the stock, or in the case of an option, the underlying stock is higher from my previous purchase. So that's kind of like a dollar cost average approach, and I always try to buy in 1/3 or 1/4 increments. And I'm going to show you examples of that as we get into the presentation. So buying in increments, of course, allows you to dollar cost average and also helps achieve that 3-to-1 profit to loss ratio. And also you want to limit the positions in a stock or option portfolio. Limit any one position to 10% or less of your total portfolio. I mean, this is just common sense. If you have 10 positions in your portfolio, they're equally weighted at 10%. If you have a 50% loss in one of those 10 positions, then that will only translate to a 5% loss for your portfolio. Conversely, if you had just 2 stocks or 2 options in your portfolio and you had a 50% loss, well, that would be a 25% loss for your portfolio. So it's just common sense. You want to spread out your positions, and if you're able, try not to have a concentration in a particular stock or option that's more than 10% of your total portfolio. And I also like to invest in different industries and sectors for diversification. Take both long and short trades. And as I mentioned, we don't have any short trades now, but you always want to keep that in the back of your mind. When the trend system signals a short trade, you have to start thinking in terms of short trades in case you're going into a bear market. And that's exactly what we did in the last severe bear market. We were heavily short in 2008, and that worked out really well for us. And when you take both long and short trades, you obviously you have a lot more trading opportunities no matter what the market's doing. And then again, we want to take both directional trades and spread trades. So our trade selection process, which I call Prime Trade Select, it's a 3-step process. I've been through this in detail in previous webinars, so we won't talk about it today, but the trade selection is a 3-step process. Step 1, we use our trend following indicators to determine the price trend. And then once we determine the price trend, we want to confirm that price trend and determine the extent of the buying and selling pressure and isolate the very best profit opportunities. So we use trend confirmation indicators to confirm the price trend. And then step 3 is we want to select an optimum entry point using the Keltner channels. This is a really important part of the 3-step process because it allows us to get a low-risk entry and have a much higher probability of success by getting that low-risk entry. And what I want to do is show you a snapshot of my 2 retirement accounts and the current profit results I have. And in these 2 retirement accounts, you'll see, I'm going to list the trade-by-trade position, but you'll see I have stock positions, ETF positions, options, and option spreads. So I like to use different types of strategies to diversify this portfolio. And you can see I limit the size of my trading positions, so a large loss in any one position is not going to cause a large portfolio loss. I think I have about 20 positions in these 2 retirement accounts. I always close out the losing trades before they develop into large losses, and I don't limit my profits by selling winning trades with a small profit. I let those profits build up over time, And that allows me to get some really big winning trades, which normally is the bulk of the profits in your portfolio over time. It's those big winning trades. I take both long and short positions. Don't have any short positions now, but I have in the past, as I mentioned, especially in bear markets. We're heavily short, and I like to trade from both sides because that gives me a lot more opportunity and more consistent profits over time. You'll see in these two retirement accounts that I have both directional trades and I have spread trades. And I like to initiate spread trades to protect my stock and option profits. And I'll show you how I do that later in the presentation here. And then I use several different types of strategies for diversification purposes. So here's a snapshot. In my first retirement account, I have a total of $483,000 in current trade profits. And in my second account, I have over $200,000. So the total right now is over $707,000 in profits. And this lists my various positions. You can see I have stock, ETF positions, option positions, spread trade positions. So right now in these two retirement accounts, I have over $707,000 in total profits. Here's the second half of that retirement account number one. Again, in this account, I have $483,000 in profits. And here's the retirement account number two. I have $224,000 profits. Again, well diversified, a lot of different positions and different types of strategies to diversify these retirement portfolios. Again, in this second one, I have $224,000. So I just wanted to give you a snapshot. I actually use these trade management guidelines every day, and it's worked out pretty well. So the trade selection has produced a lot of winning trades, both for stocks and my option positions. As I mentioned, in 2013, the market started trending better, so I have more directional trades, and they've been working out really well. And you're always faced with the question, if you have a profit in a stock or an option, do you close out that trade before it develops into a losing trade? Or do you want to hold that stock or option in case there's further gains in that stock or option? So you're always faced with this dilemma. It's a good dilemma to have when you have a profitable position. Do I close it out, or do I hold it for further gains? So what I like to do is I like to protect my profits with spread trades. And if I have a profitable position in a stock, then I'll go ahead and buy a put option and create a married put spread. And that helps protect the profits in my stock or ETF position. And I also like to do that when I have a profitable option position. I'll also, if I have a profitable call option position, I'll buy a put option to help protect those profits and actually lock in profits no matter what the direction of that underlying stock, no matter where that goes. I can lock in a profit by simply buying a put option. So I always like to protect my profits with put options. So we're going to look at stock trades first and these married put spreads. So with a married put, you own the stock, and then for each 100 shares of the stock that you own, you buy a protected put option. And the put option limits your risk, and it acts as a floor for the value of the stock. So if you own a $50 stock, you buy let's say a 50 strike put option, the value of your stock will not go below 50. It will not go below the strike price of the put option that you purchased. So that acts as a floor on the value of your stock or ETF. And while you're protecting that stock position, if the stock continues to rally, then your profit is not limited or capped. That's one of the big advantages of these married puts. If you have a profit in the stock, you buy a put to protect it. But if the stock keeps going up, then your profits keep going up. So these married puts don't limit or cap your profit potential. So this is a great way to solve that question or that dilemma. What do I do when I have a profit in the stock? So this, by buying a put, you not only protect your current profit, but it also allows you to participate in any further upside potential. And these married puts can enable you to lock in profits on an existing stock or ETF purchase, and I'll show you some examples of that. Let's look at an example of a married put trade I took. This was for the leveraged financial ETF, symbol FAS. I purchased the FAS back. This was back in November of 2012, and I held that FAS, and I purchased put options several times last year, and I'll show you an example of that to help protect these profits. You can see that from my entry point here in November of 2012, it's moved up quite a bit. It's almost tripled in price. So I have a big profit in this position, but I periodically purchase put options to help protect that profit. So here's an example. This was the FAS purchased 200 shares at 106.5. Now, after my purchase, there was a 3-for-1 split for FAS, and my average price split adjusted was $35.50. So last summer we had the looming government shutdown and gridlock in Washington. So I wanted to protect those profits I had because I didn't know what was going to happen. And in the past, these Washington gridlocks have really wreaked havoc on the market. So I didn't know what was going to happen. I had a nice profit. I didn't want to sell out in case the market recovered and went back up again. So I bought the 70 strike put options at 590 to protect my existing profits. And this is a brokerage account transaction history. You can see bought the 200 shares of FAS at 106.50 and split adjusted that was 35.50, and then bought the 70 strike put at 590. This was the October 70 strike put option. So this created a married put, and it allowed me to lock in a profit for the trade no matter what happened to the markets at that point. And at the same time, if the markets recovered, then it allowed me to participate in any further upside potential if the FAS continued to move up in price. So let's take a look at the profit loss potential for this married put trade using the married put calculator. And this will calculate the profit loss potential for this trade, assuming various price changes in the FAS at option expiration, in this example from 150% increase in price to a 100% loss in the underlying FAS. So we can see that no matter what happens, if the FAS was flat at option expiration, I'd get a 72.8% return. If it was down 25%, I would still get that minimum return. Even in the unlikely event it lost 100%, I'm still going to get that 72% minimum return no matter what happens. And at the same time, if it's going up, I'm going to get more. I'm going to participate in that further up move, and get additional profit. So this allowed me to lock in a profit and at the same time participate in any further up move in the FAS. So again, looking at this, if the stock was flat at option expiration, it had a 72% return. And the nice thing about this strategy is I don't have to worry about protective stops once I have that put option in place or big down moves in the FAS. So I simply purchase the put, and then I don't have to worry about protective stops or where the ETF is going, because I know I'm going to have the 72% minimum return no matter what happens. So this is a great way, low risk way to protect your stock profits and at the same time participate in any further up moves. And as it turned out, the FAS did go down initially during the government shutdown, but then it recovered, went back up, and I was able to participate in that further up move. Here's another example. This is for the TNA, which is the leveraged fund for the small cap index. And I also bought the TNA back in November of 2012, and we can see it's had some big up moves since then. And again, I wanted to protect my profits with the looming gridlock in Washington, so I went ahead and bought the 55 strike put at 550. And TNA, my original cost was 52.84. They had a 2-for-1 split after my purchase, so I was able to buy these put options at 550 and lock in that profit. That created a married put spread and locked in my current profit that I had in TNA. And again, at the same time, didn't limit my upside profit potential. And let's see, I don't have the calculator for this trade, but this was also very profitable. And TNA did recover, went back up, and then I participated in the further up move. Here's another example. This is for Apple stock. This was several years ago. It was on a prime trade select buy signal. And then I bought 200 shares of Apple, and I did this in 4 increments, which I normally do, as I mentioned before. I usually leg into my position with several different increments. So bought 200 shares in 4 increments. The average cost was $339.05 for my stock purchase. Then we moved in. I had a profit in the Apple stock, and then in May, the stock market went into a correction mode, and the volatility really started to pick up. And the VIX, the volatility index, actually jumped 74% from, it was at 15 in March, and it went up to 26.20 in May. So at that point, I didn't know what was going to happen. I don't know if the market was going to go in a severe decline. I just knew that the volatility had jumped, and there was a lot of risk in the market. I had a nice profit in Apple stock, so I didn't want to sell it in case it continued to rally. And on the other hand, I didn't want to give up my profits in case the market really started to tank. So I purchased the 560 strike puts at 43.50. That was in May. And I just wanted to protect my existing profits and still participate in any further up moves in Apple stock. So by purchasing that 560 strike put option, that allowed me to lock in a profit of $35,000 in my position, regardless of how much Apple stock may have declined at the time. So purchasing that put option again locked in my profits, and at the same time, if Apple stock continued to rally, I would still participate in that rally. So this is just another example. My minimum profit on this trade would have been 46%. And if Apple stock continued to go up, then I would still participate in any further up moves. And again, one of the nice things about these married puts is I don't have to worry about Apple earnings or announcements or pre-announcements or news releases, flash crashes, anything like that. Once you have that put option and protection in place, you don't have to worry about your protective stocks or where the market's going or where Apple's going, because you're fully protected with that put option. So it's a very low stress way to invest. And again, with this particular trade, if Apple stock remained flat, I'd get a 46% return. If it goes down, I get a 46% return. And if it increases 80%, I had a 59.5% return. And at the time, I had a $57,000 profit in this trade and a 75% return for the married put trade. Here's one more example of these married puts. This is for TJX. And TJX, the retailer, it's TJ Maxx stores. It was on a prime trade select buy signal, and I had a nice profit in the stock. I bought 2,000 shares at $30.48, and that was split adjusted. So after the split, I had 2,000 shares at $30.48, average cost. Again, the market went into a correction mode with increased volatility. I wasn't really sure if the market was going to go down 10 or 15%, and I was going to lose those existing profits I had in this trade. So I went ahead and bought those put options, and that enabled me to lock in a minimum profit of $14,000 for this trade. So this is a great way to protect your profits in your stock. And the nice thing about it is you don't have to worry about where the stock's going or where the market's going, because you're fully protected, and you don't have to worry about earnings or releases or news flashes. You're fully protected with these put options. So I'm showing you a snapshot now, my advisory service, and this is our married put open trade results. As of yesterday, we had $130,000 open trade profit, average return of 98%. And I've got two trades for you. Here's a trade that you can take. This is MasterCard, and it's on a prime trade select buy signal. It's in a price uptrend according to our 50 and 100-day EMA system. You can see MasterCard's making a series of new 52-week highs, which confirms this price uptrend. And we can see an upsloping on-balance volume line, which also confirms the price trend. So we can see MasterCard just took a dip here below the middle Keltner channel. So this is a good buying opportunity if you don't own MasterCard to buy MasterCard, either the stock or the option. They're about to have a 10-for-1 stock split, so you can get the option or the stock much cheaper once it has that split. So this has been a big winner for me, this MasterCard. I've owned this for a long time, and this, I think, right now is a good buying opportunity for this stock. Here's one more. This is for TJX. You can see that it's in a price uptrend, and it's making a series of new 52-week highs. So this is on a prime trade select buy signal, and we can see that it just dipped down to this middle Keltner channel, and that's, I think, is a good buying opportunity for TJX, either the stock or the option. Okay, so let's talk now about option trade management. And as I mentioned previously, the option trade management is a little different than stock trade management because options are leveraged. So we use different parameters when we're trading options. Again, our overall trade management goal, whether we're trading stocks or options, is to maintain at least a 3-to-1 or higher profit to loss ratio, and also to produce consistent monthly returns. And again, with options, you never want to risk more than your initial investment. An example of that would be if you sell a naked option, then you are risking more than you have invested. And in the past, that has led to margin calls and really getting you in trouble. So all my trade strategies are what I call limited risk, and that means that we can't lose more than our initial investment. So that's always the number one money management guideline, is to never risk more than your initial investment. Again, like a stock portfolio, we want to limit the size of our trading positions to 10% or less, and we want to close out our losing trades before they develop into large losses. And again, we don't want to close out our winning trades. We want to hold on to them and not close them out at a small profit. With the option trades, we take both long and short trades. We take both directional and spread trades, and we use several different strategies for diversification. So with options, if I purchase a call option, I'll exit that trade if the option drops 20 to 30% below my entry price. I like to give that a little more leeway than stocks because options are leveraged. And we always want to close out a losing trade before it develops into a large loss. Again, if you have a 50% loss on a trade, it takes 100% return just to break even. And by using these stop losses, that helps me maintain a better than 3-to-1 profit loss ratio. And just like I do with stocks, I like to build my positions with options and purchase in increments only if the underlying stock is higher for the next purchase. And then buying in increments allows us to dollar cost average and help achieve that 3-to-1 profit to loss ratio. And in my option portfolio, I like to limit the positions, any one position, to 10% or less of the total portfolio, and also invest in different industries or sectors for diversification. And again, with this 10% for any one position, again, that saves you from large portfolio losses. If you have a large loss in any one position and you limit your any one position to 10% of your portfolio, if you have, say, a 50% loss in an option, that'll only be a 5% loss for your portfolio. So you always want to keep that in mind. You want to spread out that risk in case you do have a big losing trade. It's not going to hurt your overall portfolio that much. And again, we take both long and short trades with options, and we take both directional and spread trades. Again, we use the Prime Trade Select to select stocks that have the best profit potential for an option purchase. And again, I'm going to show you snapshots of my retirement accounts, and you can see I have both options and option spreads in these accounts. I limited the size of my trading positions so that a large loss in any one position won't cause a large portfolio loss. And then I close out losing trades before they develop into large losses. And I don't limit my profits by selling winning trades with a small profit. And in the past, I've had short trades in my retirement accounts during the last bear market. For example, I had put options and put option spreads, and I was able to take advantage of that big down move in the last bear market. So I do take short trades in options during market down moves or bear markets. You'll see in my retirement accounts, I have both directional trades and I have option spread trades. And I'm going to show you how I initiate a spread trade to protect my option profits here. And again, here's my two retirement accounts, over $707,000 in profits in these two accounts using the Prime Trade Select and money management principles that we just discussed. In the first retirement account, I have $483,000 in profits, and in my second one, I have $224,000 in profits. So the markets have been trending well over the past year, so I have big profits in a lot of my call option purchases. So again, the question becomes, when you have a profit like that, do you want to close out that winning trade before it develops into a loss, or hold it for further gain? So again, whenever you have a profit in a stock or an option, you're always faced with this question. So with option trades, I'll go ahead and create a spread trade to lock in those profits. And if I own a call option and I have a profit in that call option, I'll go ahead and buy a put option to create a market neutral spread. And with an option trade, if you own a call option, you could also sell a call option to create an option debit spread. So there's two types of spreads I use when I have a profit in a call option purchase. So I'll either buy a put option to create what I call a market neutral spread, or I'll sell a call option to create an option debit spread. So let's take a look at some examples of that. This was for Cigna, the insurance company, and Cigna was on a Prime Trade Select buy signal. It was in a price uptrend. We can see it was making a series of new 52-week highs. We have an upsloping on-balance volume line, so it was on a buy signal. And I waited till Cigna retraced towards that lower Kelter channel. It was getting oversold. So right here, I purchased a call option as Cigna was getting oversold, temporarily oversold, because it was still on a Prime Trade Select buy signal. So right here, I purchased a call option. I bought the 50-strike call option at 17 points. And this turned out to be a low-risk entry. You can see I bought right here, and Cigna's trading up around 85 now. So I was able to get a low-risk entry right here using these Keltner channels. So I had a nice profit in the stock. So I then had to decide whether to close out that profitable call, but I didn't want to close it out in case there was further upside potential in the call option. So I wanted to protect my profits, and at the same time, I wanted to participate in any further up moves. So my brokerage account transaction history shows that I bought the 72.5 strike put at 142. So I already owned the call option. I had profit in it. So a couple weeks later, I went ahead and bought the 72.5 strike put at 142. So buying that put, that created a market neutral spread. And this allowed me to lock in a profit for that Cigna call option that I purchased, regardless of the price movement of Cigna stock. And at the same time, my upside profit potential was not capped. And as it turned out, Cigna kept moving up in price, so I kept participating in that further up move. So let's take a look at the profit loss potential for a market neutral spread trade, and the calculator will calculate the profit loss potential for this trade, assuming various price changes in Cigna stock. In this example, from a 30% increase in the stock price to a 60% decline in the stock price. So again, I bought the 50 strike call option at 17, had a profit in there, did not want to give up that profit, but still wanted to participate in any further upside, so I went ahead and bought that 72.5 strike put at 142. So we can see that if Cigna moves down in price, this trade will still be profitable, and if it moves up in price, it'll still be profitable. So if Cigna is up 10% at option expiration, I'd get an 84% return. If Cigna is flat at option expiration, I get a 43% return. And then if Cigna is down 20%, my minimum profit, no matter what happens, would be 22.1%. And then if it really took a big hit, then my profits start to increase, and a 40% decline in the stock would be a 44% return for the option. So either way, whether it goes down or up, I'm still going to profit, and my minimum profit would be 22%. So buying that put option locked in a profit no matter what happens. And again, just a 10% increase in this example would result in an 84% return for the spread. So again, I don't have to worry, once I purchase that put option for Cigna, I don't have to worry about protective stops with my option, call option purchase. I don't have to worry about bad earnings reports or big down moves in the stock. I simply buy the put, hold the put till expiration, and that will lock in a profit for me and allow me to participate in any further up moves. Here's one more example for, this is for Best Buy, and we can see Best Buy was on a prime trade select buy signal. It retraced right here, so this was June 24th. So on June 24th, I bought the 20 strike call option for Best Buy, and at that time it was trading around 26. So using the prime trade select in the Keltner channels, I was able to get a low risk entry. I had a nice profit in this call option purchase, and again, I had to decide whether to close out that call option and take the profit. But if Best Buy continued to move up in price, then I would not participate. So again, I bought that put option that allowed me to lock in a profit and at the same time participate in any further up move. And then Best Buy did continue to move up, and I did participate in that further up move. And here's the market neutral calculator for this trade. And again, we can see a small 10% increase in the stock would result in a 60% profit for the option. If the stock was flat at option expiration, I get a 23% return. So in this case, my minimum return was 22.9%, regardless of the price movement of Best Buy. So I want to discuss one more thing here, and that is multiplying our returns with option rollovers. If we have a profitable market neutral trade, at option expiration, you're faced with another high quality dilemma. Should I roll over that position into the new option, or should I close that position? So what I do is, if the stock is still on a prime trade select buy signal and it's still looking good, then I'll go ahead and roll over that market neutral spread. And if you roll it over, that reduces the cost basis of the new trade, and that in turn allows you to compound your return. So you're reducing your cost basis and risk when you roll over, and that also allows you to compound your return. So let's look at an example of that quickly. This is for Costco, and Costco was on a prime trade select buy signal. I bought the 95 strike call at 1540, and then I closed out that call for 2257. So here's my brokerage account gain loss report. You can see I purchased it for 1540, sold it for 2257. So I had a 7.17 point profit on this option. So what I did is I went ahead and rolled this option over. This was a July option, so I rolled it over into the August option. And the August option cost, let's see, $12.65. And if we roll over, we have a 7.17 profit. So that reduces my cost of the new option to 5.48. So this reduced my cost basis from $12.65 to 5.48, and then reduced my risk, and then it allowed me to compound my return. So I also purchased the August 115 put for 103 points and created a market neutral spread because I didn't want to risk losing my profits that I had in this trade. And let's take a look at the risk profile for this trade. And in this example, bought the 105 strike call, and my risk adjusted entry for that rollover again was 548. So I had that 7.17 profit, reduced the cost of the August 105 call to 548, bought the 115 strike put at 103. So now I'm protecting that profit that I have, and we can see that the minimum profit on this trade would be 100%. If the stock was flat at option expiration, I'd get 100% return for this market neutral spread. If Costco goes up 10%, I'll have a 282% return. And if it goes down 20%, I'll have a 215% return. So again, you can see either way, whether it goes up or it goes down, I'm going to profit on this trade. So what I did is at August option expiration, the stock was still on a prime trade select buy signal. So I rolled over the August options into September, and I closed out the cost for the August spread was 651. In other words, that was the cost for the combination of the call option and the put option. So the cost was 651, and then I closed this spread out at 1424. And this shows the sale of the August 105 call at 1401, and the sale of the August 115 put at 23. So I closed it out at 1424. So for the spread, I had a profit of 773, and that reduced the cost of the new September spread by 773. So again, by rolling over, it allowed me to reduce my cost basis and risk and compound my returns. And here's the actual spread order I used. I like to use spread orders on these rollovers because that reduces the brokerage cost and also allows me to, normally I can split the difference between this bid-ask price on these options. If I put it in midway between the bid and the ask, I can usually get filled midway. So I like to use option spread orders to roll over the options. And you can see in this example, this is the actual spread order I used. I closed out the August 105 call and then bought to open the September 115 call. Okay, and this is the rollover for the put option side of the spread. I sold to close the August 115, and then I bought to open the September 120 call. So now I've rolled this over twice, so my cost for the spread is pretty low, and of course that's going to allow me to get a large percentage return because I reduced my risk to almost zero. So the minimum profit on this trade is 1,090%, no matter which direction the Costco stock goes. So if in this example, if Costco stock goes up 10%, I get a 3,795% return. If it goes down 10%, I get a 2,881% return. So these high percents are a result of reducing my cost basis almost to zero. So, and as it turned out, Costco stock did correct after I initiated this September spread. And we can see that I owned the September 115 call and the 120 put. So I'm going to have a nice return no matter what happens. Now compare that to if I just owned the 115 strike call and Costco closes at 115 or lower, then I'm going to have the 100% loss for that call option purchase. So that shows the difference between these spreads and just owning the call. So in this example, if you own the 115 call and you didn't own the put option and Costco closed below 115, then you're looking at 100% loss for your call option as opposed to a minimum return of 1,090% for the market neutral spread. So that's an example of why we do these market neutral spreads in case there's a correction in the stock. You don't want to give up the profits that you already have, and the market neutral spread allows you to lock in a profit and at the same time participate in any further upside move. This was a snapshot in my retirement account. These are market neutral trades. Average return for these trades was 422%. And even if the underlying stocks in these for these options went to zero, I would still have a profit in this portfolio because of the put option protection. So that allowed me to lock in a minimum profit no matter what happens. And at the time I took the snapshot, this portfolio of market neutral trades had an average return of 422%. This is a snapshot of the advisory service as of yesterday, our market neutral portfolio. We have a $198,000 open trade profit, average return of 786%. So I am going to run out of time here. I'm not going to be able to get into the option spread trades, but we can do that at a different date. So that concludes my presentation for today. And I'd like to take any questions you might have. And if you want to get an update on any of these strategies, just log on to weeklyoptionalert.com, or you can call Brad toll free. And if you want to get an update on the profit results, just log on to weeklyoptionalert.com and click trade results, and you can get an update. We update the profit performance for these various strategies. So that concludes my presentation. I'll be glad to take any questions you may have about these strategies we covered today.
I can tell you now that you had a lot of questions today, so there was a lot to cover in that presentation. I'm going to ask you a few that were generally asked by most members within the group. First one, a basic question: where do you start to look for these new stock trades?
Okay, that's a great question. Where do I start to look? The best place to look is the new 52-week high list, and I check this list almost every day. And by doing that almost every day, you're going to see certain stocks keep making this new 52-week high list. And that's a great place to start your research for stocks that are that have a lot of profit potential. And once they make that new 52-week high list, you know they're in very strong momentum, and they're the most likely path after they make that new 52-week high list is to keep going up. And so you check that new 52-week high list. Then I'll make a list of these stocks that keep making this new 52-week high list. And then I'll check those stocks when they have temporary pullbacks using the Keltner channels. And then when they have a temporary pullback, that's when I pull the trigger and I'll go in and purchase a stock or buy a call option.
Okay. I know that. Do you find that the Mary put protection to be used? Have you found a correlation with events with that, geopolitical events and stuff like that? Is that one of the reasons you used the married puts?
I have used the married puts several times over the last several years. Whenever there's an event coming up in Washington, whether it's a battle over the increasing the deficit, or just recently the government shutdown, the federal government shut down. So prior to those type of events, I'm going to buy put options on my stocks and my options to help protect those profits, because you never know what's going to happen as a result of these events. And sometimes we've had some pretty severe sell-offs. So, you don't want to give up those profits you have. So you buy a little put protection. It's going to cost you a little bit of money. It's going to reduce your profits a little bit. But in my mind, it's well worth it to have that protection and not have to worry about a severe market decline.
And as a general statement, Chuck, I know that you do a lot of methodical number crunching and things of that nature to come up with your individual stock picks and strategies. Do you have an overall feel on the market for 2014? And if so, can you share it with us?
Yes. As you said, I simply follow my systems and my trading strategies, and I'm very disciplined about that. But if I was to guess, I would say, we're going to have a good return in 2014, probably not as much as we had in 2013. But I'm expecting a reasonably good return, and we will take advantage of that with both our directional trades and our spread trades. And the spread trades, of course, protect us in case I'm wrong. So that's why we initiate those spread trades, in case your predictions or your feelings about the market turn out to be wrong. So. But my personal guess would be that we'll have a reasonable return in the stock market in 2014, maybe in the order of 10 to 15%. But again, if we don't, I have those spread trades that allows me to protect my profits if I'm wrong.
Well, Chuck, I know that there's some people asking, why did Chuck go through those last slides so quickly? Well, sorry, folks, but we ran out of time here. So, Chuck, I'm going to hold you to coming out next month again and finishing up the presentation for us.
Okay, yes, I'd be glad to do that.
So if for those of you that want to hear the archive, if you have questions, by all means, contact Chuck's support staff. They can give you the ins and outs of his programs and the strategies. Chuck, I'm going to take over the reins just so you know.
Okay.
For those of you that want to view this webinar again, I'm going to have this archived. I'll have it archived tomorrow. I'm going to be pulling up the site right now for you. It's www.mytrademonster.com. Should be on your screen now. Right here on the right-hand side is where we keep our webinar archives. And I have to thank Chuck for it. Chuck, you've always allowed us to basically hold those archives so people can download them, view them, etc. And I appreciate you allowing us to do that. But for those of you that weren't able to get sound today, or joined in the middle, or were a little late, click on the free education area over here. Free education is going to tell you our upcoming webinars, such as this one here. And on the right-hand side, we'll have all our archives. I'll have that up there tomorrow morning sometime. Otherwise, I want to thank everyone for attending and coming out. Happy New Year to everyone. Chuck, thanks again for taking the time to do this with us.
Okay, thank you, Tom, for setting this all up. And I want to wish everybody a happy new year, happy and prosperous new year.
Thanks a lot, Chuck. Everyone trade happy, trade like a monster, and best wishes to everyone's trading in 2014. See you next month. Thanks again, Chuck.
Okay, thank you. Good night.
Good night, everybody.